In the world of finance, Microstrategy founder Michael Saylor stands firm in his conviction that Bitcoin's value is bound to soar even higher. Microstrategy made headlines in 2020 by becoming the first publicly traded company to include Bitcoin in its balance sheet. Since then, the company's stock has skyrocketed by 140%, and its market capitalization has increased nearly tenfold, transforming it from a $600 million company to one valued at $4 billion. Saylor boldly claims that Bitcoin stands unparalleled. He firmly believes that no other asset can rival Bitcoin's potential to multiply its value by a factor of 10. With a keen understanding of market dynamics and an unwavering belief in Bitcoin's potential, Saylor's insights provide a captivating glimpse into the future of finance, where Bitcoin's value continues to skyrocket, setting the stage for a revolution in the industry. Hello and welcome back to another video on our channel, Finance Sense, covering all the latest trends in the financial markets and the economy. In an interview with Kitco News, Saylor discussed how acquiring Bitcoin had immensely benefited Microstrategy and added substantial value to the company. However, according to Saylor, the banking industry is facing a significant and widespread problem that has been unfolding recently. He expressed concern that many banks and financial institutions would not be able to enjoy these advantages due to their predetermined negative stance on Bitcoin, combined with existing accounting and regulatory obstacles. Saylor confidently claimed that, after extensive research and consideration of various assets, there is simply nothing that can rival Bitcoin. He emphasized that no other asset has the potential to increase one's value by tenfold as Bitcoin does. In his detailed analysis during the interview, Saylor offered insights into the concept of inflation, highlighting its colloquial usage and how central banks tend to define it within the framework of the Consumer Price Index. However, he expressed reservations about relying solely on the CPI as a measure of inflation. Saylor contended that the CPI primarily reflects the costs associated with non-scarce assets, such as everyday consumer goods like boxed cereal or cookie-cutter apartments mass-produced with inexpensive materials. This perspective led him to question whether the CPI accurately represents the true inflation rate. Saylor then proposed a different approach to understanding inflation, focusing on the rate at which currency expands in relation to scarce and desirable assets. For instance, if the cost of such assets were to increase by 20% per year, he argued that the inflation rate should be considered as 20%, irrespective of the CPI. By emphasizing the importance of distinguishing between the inflation rate tied to scarce assets and the CPI's measurements, Saylor sought to challenge conventional thinking on the topic. Furthermore, Saylor addressed the negative real yield that currently exists in many financial systems. He observed that the CPI in certain countries like Argentina surpasses the prevailing interest rates, resulting in a problematic situation where the purchasing power of money diminishes over time. While estimating the real inflation rate in the US dollar to be around 10 to 15% per year, Saylor highlighted the extreme case of Argentina, where the CPI inflation rate reaches approximately 105%. This contrast served as evidence that the true inflation rate when considering scarce and desirable assets could be as high as 150%. In Saylor's analysis, he also discussed the global nature of monetary inflation, attributing it to many currencies being pegged to the US dollar. He emphasized that even the strongest currencies do not outperform the dollar in this regard. Consequently, he suggested that individuals face a choice between inflation rates in the low teens within the dollar system or higher rates by opting for weaker currencies. These higher rates could range from the 20s to as much as 100% or more, depending on the specific country. Saylor then delved into the challenges associated with holding bonds and the predicament faced by banks. He pointed out that since his company purchased Bitcoin, the bond index had experienced an 18% decline. This decline in value meant that if someone had leveraged their assets at a ratio of 10 to 1 and invested them solely in bonds, they would have ended up bankrupt. Saylor explained that banks found themselves in a similar position due to their high leverage and heavy reliance on mid-dated and long-dated bonds. This reliance on bonds made them technically insolvent. Interestingly, Saylor highlighted that if the banks had invested in Bitcoin instead, they would have avoided insolvency. However, regulatory restrictions prevented regulated banks from investing in Bitcoin, leaving them without a viable winning strategy. Saylor continued by discussing the challenges faced by regulated banks when it came to fixed income investments. He explained that even if the short-term Fed funds rate were to experience a significant increase, fixed income assets would still face downward pressure. The question was not whether they would decline, but rather by how much, whether it would be 5%, 15%, or even 20% over a given time frame. Saylor emphasized the need to convert treasury holdings into tangible assets that were not subject to government debasement. With a hypothetical scenario of having $500 million, Saylor pondered the options for investment. He considered purchasing buildings, oil rights, timber, coal, soybeans, gold, or Bitcoin. However, he expressed difficulty in finding $500 million worth of art as an inflation hedge, as art tends to appreciate over time. In contrast, the value of the dollar does not show the same long-term appreciation. Saylor explored other possibilities, such as buying land or a commercial real estate portfolio. However, he found that these options were either overvalued or restricted by accounting rules and laws that limited the percentage of a corporation's balance sheet that could be invested in securities. Saylor acknowledged the availability of holding treasuries as a carve-out within these rules. Although technically securities, treasuries were considered property or commodities for accounting purposes. Nonetheless, he concluded that investing in the S&P index was not a viable solution either. Such an investment would not provide added value to investors because they could easily purchase the index themselves. Moving along, Saylor contemplated the search for a valuable commodity that could preserve its worth and add value to investors as the dollar continued to lose value. His exploration led him to consider gold, a tried and true form of sound money for millennia. However, he also recognized the limitations and drawbacks of physical gold, such as its difficulty to move, vulnerability to theft, and ongoing debasement through mining. In the world of cryptocurrencies, Saylor discovered a remarkable alternative: crypto gold. This digital asset offered all the benefits of gold, a bearer instrument with no counterparty risk and non-sovereign store of value, without the associated drawbacks. The concept intrigued him, and he envisioned an ideal form of gold that was faster, smarter, and stronger. This hypothetical digital gold would have a limited supply of 21 million coins, be impossible to mine more of, easily transferable, and be programmable at lightning speed. Upon studying the vast array of crypto assets available, Saylor determined that Bitcoin emerged as the most decentralized and promising option. Unlike other cryptocurrencies, Bitcoin had not gone through an initial coin offering or a pre-mine, nor was it controlled by a corporation, core devs, or the Bitcoin Foundation. It had even weathered a civil war over its future, with those attempting to corrupt or alter it. Bitcoin's unique characteristics and provenance convinced Saylor that it was the true digital successor to gold. Moreover, Saylor realized that a choice had to be made between Bitcoin and traditional gold. As intelligent investors embraced Bitcoin, its value would appreciate at a faster rate, leading to the decline of gold. He emphasized the transformative effect this realization had on Microstrategy, his own company. By investing in Bitcoin instead of gold, Microstrategy experienced remarkable growth. The company's enterprise value had multiplied by a factor of 10, while its market capitalization had quadrupled. They had transitioned from holding a dead money asset, the US dollar, to a digital asset appreciating at an impressive rate. Saylor likened the company's shift to becoming a digital real estate investment trust, backed by billions of dollars in digital scarcity. This strategic move had propelled Microstrategy's financial strength, rendering it the best capitalized it had ever been. The transformation enabled the company to leverage the potential of Bitcoin and accumulate significant assets, far surpassing its previous position of holding mere liabilities. In summary, Saylor's realization of Bitcoin's potential as a superior form of digital gold revolutionized Microstrategy's fortunes, while also highlighting the potential missed opportunities for banks and financial institutions that remain skeptical or constrained by regulations. Their strategic shift from traditional assets to appreciating digital assets had fundamentally transformed the company's financial standing and positioned them as a leader in the digital realm. It sounds like we've reached the end of this video. If you found this video helpful, please hit like and subscribe, and comment down below your thoughts in the comment section. This is Finance Sense, helping you keep up with all the latest trends in the financial markets and the economy. See you next time!